Okay, we're going to do a one-take challenge on this one. Fixed rates continue to free fall. That's right. Fixed mortgage rates are going lower and lower and lower as we enter 2024. They have gotten lower pretty much every week for the last 6 to 8 weeks, and it looks like they still have some bandwidth to get even lower. So if you're new here and you haven't subscribed to this channel before and you want to see what's going to happen with interest rates, Canadian mortgage rates throughout 2024, make sure you hit the subscribe button and make sure you hit the like button so more people like you can see this video and so that you can get the future videos. By the way, I've got a couple series on how to buy real estate in 2024 that you aren't going to want to miss. So let's check out interest rates. Let's see what's going on. I'm going to start real quick here by showing you bond yields. This is what fixed rates are priced off of. This is exactly the thing you need to look at if you're looking at fixed rate mortgages to try to determine where rates are going to go. And what's really interesting about this chart is at the end of December, early January, we were down at about 3.17% on the 5-year Canada bond yield. Now, the last time that bond yields were that low was May of 2023. And what the rates were at that time was 4.59%. So what you're going to see in a second here is the current 5-year fixed rates. And you're going to see that they're considerably higher than that. And what that means is that the banks and the lenders have considerable bandwidth with respect to lowering interest rates further if and when they decide to get competitive. And my guess is that usually around March and April is when they start to get competitive. They start to try to fill up their books of business. And my guess is that the margins, so the amount of money that they make off the mortgages, are going to start to shrink around that time as various lenders try to get more business. So this is good news. Now, there's been a little bit of bump up here in the last week or so. The reason why is because of the positive job numbers out of the US, which indicates that the market could, or the economy could be doing better than expected, which could be inflationary, which ultimately could lead to maybe not as many cuts as were expected previously. So that's something to watch if the US economy, or the Canadian economy for that matter, continues to run at full tilt and the numbers with respect to employment, with respect to growth and GDP start to get better, or if those inflation numbers start to tick up, it could actually mean that interest rates may not go down as much as expected. Now, let's get into what you came here for, which is the actual 5-year and pretty much every other rate, but I'm going to go through the variable, I'm going to go through the fixed, and I'm going to go through the 3-year and show you exactly where things are at right now. So insured mortgages are now priced at 5.24%. The last time we did an update, you can see they were priced at 5.54%. So this is a 0.3% reduction in basically just 3 to 4 weeks, which is a big reduction. And like I said, there's some bandwidth for these to go lower. By the way, I'll show you the discounted rates, the super ultra low rates a little bit later on. You'll see that they're even lower than this. But one thing to keep in mind with those is that they come along with a catch. They always have a catch. You get what you pay for in pretty much everything in life. And if you are getting an ultra low rate mortgage, you are getting some sort of mortgage that has some sort of feature stripped away or some way for them to get you in the future. And I'll talk a little bit about that in a couple of minutes. Or you can also go to mortgagesecrets.ca and get a copy of my free book. This is totally free. All you have to do is pay shipping and handling. The reason why it's free is because I want people to be able to get all the information that they need on how to get a mortgage and have information about things like discount mortgages and why they are maybe not the best case scenario for most people. And by the way, the reason why, and by the way, sorry, 1 second here. This is live and it's going to be one take. Have a little bit of a sip of my drink here. The reason why I want everybody to have access to this, and the reason I want everyone to pay for the shipping at least, is because we know people get value out of things that they pay for. And when you get a physical book that you paid shipping for, the likelihood of the fact that you're going to read this very short but very important, full of information book is a lot higher. So mortgagesecrets.ca. Anyways, back to the rates. Now, if you're putting greater than 35% down on a mortgage, you no longer have to have mortgage insurance, of course. And that is where interest rates are about the same as what they would be if you get an insured mortgage, which, by the way, the insured mortgages are almost always the cheapest. Reason why is because they have insurance, which means they have virtually zero risk for the lender. So the pricing's lower. Of course, you pay for that by paying for insurance, which ends up costing you more, but that's the reason why the rates are lower, is because they're less risk for the lender. Now, as we get to less and less of a down payment, up to 20% down, you start to get higher interest rates. Now, it used to be you put 20% down, you got the best rates. Not anymore, because 20% down is the threshold where the lenders have the most risk. It's because that is the threshold where you are putting the least amount possible that you can put down. So 30% down, you're looking at 5.34%. At 25% down, you're looking at 5.39. At 20% down, you're looking at 5.49. And if you're looking for an uninsurable mortgage, so that means a mortgage where you're getting a refinance, where you are getting a $1 million plus mortgage, or where you're getting a 30-year amortization, so longer than the standard 25. This is where the lenders can't back insure your mortgage, so they can't pay for the insurance in order to make the mortgage less risky for them. So you end up paying slightly more So you end up paying slightly more when you're getting one of those types of mortgages. In fact, you'll pay substantially more in a lot of cases. So keep that in mind. If you're looking to buy over $1 million purchase price, if you're looking to refinance, or if you're looking to get a 30-year mortgage, you're going to pay more for that. Now, moving into 3-year fixed rates, I took the 4-year fixed rates out of this because they've actually gone up surprisingly, and they definitely aren't getting any better. So we'll take a look at the 3-year fixed mortgages, which have come down since the December rate update. So we're looking at 5.54 now on a 3-year with insurance. We're looking at greater than 35% down at 5.54%. 30% down is 5.79%. And actually, I think a bunch of these are at 5.79%. Yep, that's right. And basically, so if you're putting 30 to 20% down, you're paying the same rate. And then uninsurable, this is actually a pretty good rate. A 3-year might be something I would consider versus a 5-year, because you're getting a slightly better deal on it right now than you are on a 5-year. But with it only being about 0.05 better rate, I might actually not do that. So I think when you're taking a shorter term mortgage, you got to be getting a 10 to 20 basis point advantage over a 5-year fixed, that in order for it to make sense. If you're paying the same rate or more, it makes no sense to get that. And you should probably look at getting a full 5-year mortgage with a low penalty, which means not getting a mortgage at a big bank, but getting a mortgage at a lender like First National, MCAP, or CMLS. These are the monoline lenders. They aren't household names. And the reason why they have better rates is because they have to. They have to have better rates. They have to have better products, because they can't skate on their brand or the brand loyalty that comes with a big name like a Royal Bank or BMO or a Scotiabank or TD or a CIBC, or whatever your flavor of the year is for the bank that you love. Now, moving into 5-year variable rates, these have actually gotten slightly better on 2 of the down payment ranges. And that's surprising to me, because these haven't moved much in probably 4 or 5 months. For the most part, they're pretty much the same. Prime minus 0.9 on an insured mortgage, prime minus 0.9 on greater than 35% down, 30% down, 25% down, 20% down. I'll let you read those rates there for yourself. You can just pause the video if you want to see them. And then uninsurable, this is actually getting a little bit more expensive right now. We've seen some lenders actually reducing the discounts, which means the rates are going to be higher. But basically what you can bank on if you're looking at a variable rate mortgage is being around that 6.3 to 6.5% range, which begs the question, even if you think interest rates are going to go down, why would you choose that over a 5-year fixed mortgage right now when you can get it for almost 1% to 1.5% lower than what you would pay for a variable rate? Makes no sense. And keep in mind, everyone is expecting interest rates to go down right now. The Fed in the US is saying 3 reductions by the end of the year, which is 0.75%. Bank of Canada predictions are around the same. But keep in mind, these forecasts are often very, very, very wrong. Does anybody remember Tiff Macklem saying interest rates are going to remain low well into 2023 and possibly into 2024? And look at where we are now. So if you're choosing a variable rate mortgage because you're looking at forecasts, and the forecasts are that interest rates are going to go down, be very, very aware that that may not actually happen. And you could end up finding yourself in a situation where rates don't go down and where you're paying significantly more for a variable rate mortgage. So the best strategy, I think, is you take the mortgage that is the cheapest at the time you get the mortgage. And if rates do go down, you make sure that you chose a mortgage with a lender that will be able to have a low penalty so that you can refinance, switch to a different lender, pay the penalty, get a lower rate, and get the best of both worlds. And if you need help with that, just go to mortgage360.ca and we can make sure you are set up with exactly the mortgage that you need in order to do that. Now, moving into the discount rates, I'm not going to go through these individually. You can see that they have dropped below 5%, which is kind of cool. But keep in mind, you get what you pay for here. The biggest problem with these right now is the fact that most of them have what's called a bona fide sale clause, which means that you can't get out of the mortgage unless you sell the property or until you wait for the mortgage to come up for renewal. And what that means is that you cannot refinance to a lower interest rate if rates go down. So you pay a little bit less right now, but you won't have options if rates do in fact go down, which makes the 0.2% or 0.25% that these are cheaper really not worth it. Because when you look at that 0.25%, it's probably a cup of coffee or a beer or a glass of wine every single week when it comes to the, oh, wait, I got bourbon here, or a glass of bourbon. And that difference in the price, even though it seems like it's a lot from a percentage standpoint, from a nominal standpoint, it isn't much. But getting that slightly better deal from a dollar perspective isn't necessarily worth not having the ability to get a lower rate down the road. So keep that in mind. When people understand the differences between normal mortgages and the mortgages that you Google online and find the lowest rate for, they typically end up choosing the normal mortgages because of the flexibility, the options, and the long-term ability to actually get a better deal if you use some strategic mortgage strategy. Now, moving into the variable rates, I'll just show you these as well. Again, pause on the screen if you want to take a look at them. And again, same problems here with these. It's not worth the extra 0.2% to get these rates and not have the ability to lock into a different lender. By the way, the big problem with the variable discount rate mortgages is that you cannot lock in or you cannot switch to a different lender, which means you have to lock in with the lender that you're with, which means they can pretty much say, if you say, I want to lock into a 5-year fixed, they can say whatever rate they want with respect to the rate that you can lock in at. And because you can't switch to a different lender, you pretty much either have to stay variable or accept that rate because you don't have any options. You don't have any negotiating power in the event that you actually have those discount mortgages and they've got you over the barrel. They get to charge you whatever, and it is what it is. So those are the interest rates for January of 2024. Let me know in the comments what you think is going to happen with interest rates. Make sure you check out this video right here for more information on the Canadian real estate market. And if you made it all this way, I've got a secret for you. You can still get my Rate Secrets course, and you can still get access to the Homebuyer Masterclass by going to the links in the description below for significantly cheaper than what they've ever been sold for. I retired the Rate Secrets course. If you buy that, you'll get all the updates for the rest of the new courses that come out that are, or the updated version of that course, I should say. That sale, I kind of told everybody it was over, but the link's still active. So if you're watching till the end of this, you